Hi, today I am going to explain another problem of income from house property. Let me explain the problem first. Mr. Sharath has the following properties. Flat in Bombay purchased on 1st August in the previous year, which is let out from 1st September on a monthly rent of Rs 2000. The building in which the flat is located was completed on 1st July in the previous year. The first point you have to note down here is the Bombay flat purchased on 1st August in the previous year. The SEC is the owner of the property from 1st August onwards. SEC is a Mr. Sharath. Mr. Sharath is the owner of the house from 1st August onwards. So we have to calculate the income from the month of 1st August or from the month of August. And another point, it was let out from 1st September in the previous year. SSC borrowed it in the month of August, but it was let out from 1st September in the previous year. So the August month is considered as a unoccupied, and that is called as a vacancy period. The August month is considered as a vacancy period for the first house or for the Bombay flat, and it was let out on a monthly rent of Rs 2000. That is the rent of the house or rent of the Bombay flat. And another point, the flat in which the flat is located was completed on 1st July in the previous year. The flat is located, the Bombay flat, which was completed on 1st July in the previous year. See, this date is not required for our calculation because Mr. Sharath, the SSC, is the owner from 1st August onwards. The details of the information related to Bombay flat from 1st August onwards will need to be considered because before August, the SSC is not the owner. So under income from house property, first point is the SSC must be the owner of the property. Then only it is assessable under that particular person. So here in the month of July, SSC is not the owner. SSC is the owner of the house property from August onwards. So therefore, this information is not required for our calculation. So that is in case of a first flat. Next, flat in Delhi used for own residence. So we can consider it as a self-occupied property. Later there are some points related to this one. Okay, later I will explain it. Next, third point, Godown in Kolkata is another property. Is let out on a monthly rent of Rs 6000. So third property is a let out property and monthly rent Rs 6000. The particulars for the year, the other informations, three properties, Bombay, Delhi and Kolkata. Municipal value, fair rent, municipal taxes, building maintain cooperative maintenance charges, and fire insurance premium, collection charges, repairs and interest on loan for first house and second house, Bombay as well as Delhi flat, and Kolkata Godown, the interest on loan is not given. The following further information is given. The flat in Delhi is let out from 1st January of previous year for residential purpose on a rent of Rs 4000. So please note down this point. The flat in Delhi is let out. The flat in Delhi is let out from 1st January of the previous year. Earlier, under point 2, it has been specified or it has been given that flat in Delhi used for own residence. Now it has been given that the flat in Delhi has been let out from 1st January of previous year for residential purpose for a rent of Rs 4000. See, in case of second flat or Delhi flat, it was used for part of the year as a let out and part of the year used as a self-occupied. See, in case if any house property for a part of the year used as self-occupied and part of the year used as a let out, then the entire house property to be calculated as let out property, but while calculating rent received, it has to be calculated only for let out term. So in this problem, Delhi flat from the beginning of the previous year till 31st December, it is used by SSE for own residence. And from January onwards, it was used as a let out property. So it means the part of the year used as self-occupied and part of the year used as a let out. So we have to consider it entire property as a let out property. But while you are calculating rent received, it has rent received to be considered only for let out term. All other values for a year for 12 months, but only rent received is for a let out period. So now the Delhi flat is a let out property. Next point is he suffered a loss of rupees 15,000 in the business. It is a business loss which is not related to our in category, means not related to this head of income. It's not comes under income from house property. Then from a part-time job he earns a salary of rupees 5,000 per month, and that comes under income from other sources. Again, it is also not related to income from house property. So these 2 points are not related to our calculation, because here our calculation is restricted to income from house property. These two are not considered under income from house property. So here there are three properties: Bombay flat, Delhi flat, and Godown at Kolkata. All the three properties were let out property. Let me assess the first flat or first property, that is a Bombay flat. The Bombay flat is used by SSE from 1st August in the previous year, because the SSE purchased in the month of August in the previous year. It means SSE is the owner of the property from 1st August onwards. So we have to assess the Bombay property from 1st August to 31st March, or we have to find out the income of the Bombay property for 8 months, that is from 1st August to 31st March. So first one, municipal value, it's given annual municipal value, it's per annum 20,000. So we have to convert it for 8 months. So 8 months municipal value rupees 13,333. Next is the fair rental value. Fair rental value is also to be converted for 8 months. So 8 months fair rental value is 12,000. Now higher of these two is considered as a expected rental value. Expected rental value is 13,333. Here no standard rent, so therefore higher of municipal value or fair rental value is considered as a expected rental value. Next is the rent received. Here the house was let out for 8 months. Here the house was let out for 7 months. It was let out from 1st September onwards. So total let out duration is 7 months. SSE used it for 8 months and 1 month is unoccupied. So total let out duration is 7 months. So we have to calculate rent received is only for let out duration. Let out duration is 7 months. So 2,000 into 7 months, 14,000 is a rent received. That 1 month, the August month, is considered as a vacancy. Unoccupied month is considered as a vacancy period. Next is unrealized rent. No unrealized rent here. So after considering vacancy period and unrealized rent, the total rent received for a let out duration is 14,000. Next, gross annual value. So whenever there is unrealized rent or vacancy period, then gross annual value is equal to rent received. So here 14,000 is a gross annual value. Because of vacancy period, rent received itself is the gross annual value. Next is the municipal taxes. The municipal taxes is a 2,000. So we have to deduct it from gross annual value. Then you will get net annual value 12,000. Next is a deduction under section 24. The first one is a standard deduction. It is 30% on a net annual value. So net annual value into 30%. So 3,600 is a standard deduction. Next, interest on loan, which is given in the problem. 2000 is the interest on loan. So 2000 interest on loan. No other information related to loan. Direct interest on loan is given, that is 2000. So after considering the standard deduction and interest on loan, the total income from house property is 6400 for the previous year. 12,000 minus 3600 and minus 2000. The balance is 6400 is the income from house property. That's the income of Bombay flat. So in this property, one point you have to note down that the house was used or owned by the SSC from 1st August onwards, and it was let out from 1st September onwards. Means here the Bombay property, part of the year used as let out and part of the year used as unoccupied property, and the August month where the house was unoccupied, that month is considered as a vacancy period. So that is the income of a Bombay flat. Okay, next we will assess the second property, that is a Delhi flat. Delhi flat in the beginning used as a own residence. Later it was used as a let out property from 1st January of a previous year. In the beginning it is used as a residential house, and later it was used for let out purpose. So whenever any house property part of the year used as a let out and part of the year used as a self occupied, then for the full year the house property to be considered as a let out property. So therefore Delhi flat for the throughout the year is considered as a let out property. The municipal value 42,000, fair rental value 45,000, standard rent not applicable. So expected rental value of Delhi flat is 45,000. Higher of 42,000 or 45,000, whichever is the highest is expected rental value. Next is a rent received. Rent received for let out term. Remember, always rent received is only for let out period, let out duration. So here Delhi flat was let out from 1st January. So you have to calculate rent received from January to March. For 3 months only it was used as a let out property. So rent received is only to be calculated for let out period. Other details, other information or other details to be calculated for throughout the year. Only rent received or receivable is for let out term. So here monthly rent of Delhi flat is 4,000. So 4,000 into 3 is 12,000 is a rent received. No unrealized rent. So total rent received for a year or for the let out term is 12,000. Next is a gross annual value. Municipal expected rental value or rent received, whichever is higher is a gross annual value. So here you have to compare expected rent with the rent received, whichever is highest is a gross annual value. Why you have to compare it with the expected rental value? Because here no vacancy period, no unrealized rent. So whenever there is no unrealized rent and vacancy period, the expected rental value or rent received, whichever is highest is gross annual value. So gross annual value is 45,000. Next, municipal taxes paid is 8,000, and after deducting the municipal tax from gross annual value, the net annual value is 37,000. Next, deduction under section 24, the standard deduction first, that is 30%. 37,000 into 30%, so 11,100. Next is the interest on loan 6,000, which is given in the problem. 6,000 is the interest on loan, and balance is 19,900 is a income from house property. That is the income of Delhi flat. Next we'll assess the income of next property, that is a Kolkata property. Throughout the year used as a let out property. No much information related to Kolkata property. Throughout the year used as a let out. Municipal value 60,000, fair rental value 66,000, no standard rent. So therefore higher of 2 is a expected rental value 66,000. Next, rent received is 6,000 and total let duration is 12,000. So rent received is 72,000. no unrealized rent, no vacancy period. So rent received is 72,000. Next, gross annual value. Expected rental value or rent received, whichever is the highest, is a gross annual value. 66,000 or 72,000, whichever is highest, the higher is 72,000, because here no vacancy, no unrealized rent. So you have to compare it with the expected rent and expected rental value or rent received, whichever is higher, is a gross annual value. Next comes municipal tax, it is 18,000, and after deducting municipal tax, the net annual value is a 54,000. Next, deduction under section 24. The first one is a standard deduction, 54,000 into 30%, it is 16,200. Next, interest on loan, it's not given, no interest on loan for the third property, it's nil. So after considering standard deduction from net annual value, the balance is 37,800, and that is the income of Kolkata property. So this is the grand total of three properties. The first, Bombay flat 6,400, second Delhi 19,900, and Kolkata 37,800. Total income is 64,100. So here there is a income from house property. So total income is 64,100. Thank you very much.